On budget day, we were glued to our screens watching Finance Minister Srimati Nirmala Sitharaman deliver the budget for FY 2024-2025. Now the room was buzzing with background noise as everyone was keen to hear the announcements. On another screen, we were watching the Indian stock markets. At first, the markets jumped up as soon as the Finance Minister began her speech. But within minutes, they took a sharp dive and slipped into red. So why did this happen? Why did investors quickly turn negative about the budget? When the Indian markets react positively to the union budget, it is typically meant that the budget has instilled a lot more confidence amongst investors, businesses, and the general public. So, did the confidence in the government's economic management and policy directions falter this time? Do investors believe that the union budget is detrimental to the economy and the financial markets? Let's discuss exactly that in this week's episode. Stay tuned, you're watching Informed Investor, the Third Empire, an initiative by Research and Ranking. Let's begin. Union Finance Minister Srimati Nirmala Sitharaman ji presented the union budget for the 7th year in a row. However, the economic conditions now are very different from when she first presented the budget. Our bank and corporate balance sheets have improved. Our tax revenues are doing good and we have a healthy forex reserve. However, there are two main concerns that we are currently facing. Slowing consumption growth due to a weak private sector investment. While the Indian economy grew at a world-beating 8.2% in FY 2023-2024, consumption has grown at only half that pace. Additionally, the middle class has been asking for relief from high taxes that it has faced over the years, especially in the face of high inflation. And politically too, things have changed for the first time in the past decade. The ruling Bharatiya Janata Party needed the support of its allies in the National Democratic Alliance to run the government. Now the union government relies on the support of the Janata Dal United from Bihar and the Telugu Desam Party from Andhra Pradesh. Now the Bharatiya Janata Party also had a below par performance in rural seats during the recently concluded general elections of India. Some wondered how the government would react to its weaker election performance. Would there be a shift towards populism like in the recent state budget that we've seen, or would there be a new reform measures in line with the government's earlier promises of transformational change? Now we will have an answer to all of these questions by the end of this episode. Coming to the budget, the union budget for financial year 2024-2025 emphasized aid for the underprivileged, women, youth, and the farmers. Now the finance minister laid down 9 priorities of the budget, which includes productivity and resilience in agriculture, employment and skilling, manufacturing and services, support for promotion of MSMEs, energy security, innovation, research and development. Now in this video, we will discuss only those announcements that are relevant to you, the common people, and you can be an investor, a taxpayer, or even the youth. Now let's address the most popular question coming out of the budget. Is the budget squeezing the middle class? Firstly, let's discuss why the market took a significant dip during the intraday trading while the budget was being announced. When Nirmala Sitharaman ji spoke about the B component and moved to taxation, the market reacted negatively. First up, there's good news for the salaried employees, but only for those who have opted for the new tax regime. The finance minister has announced an increase in the standard deduction. Previously, you could claim 50,000 rupees as standard deduction, but now this has been increased to 75,000 rupees. According to the finance minister, this will benefit 4 crore salaried taxpayers and pensioners. Next, the tax rates have been tweaked a bit. There is no tax on income up to 3 lakh rupees just like before. 5% tax is applicable on income between 3 and 7 lakhs, which used to be up to 6 lakhs earlier. 10% tax is applicable on income between 7 and 10 lakhs, which used to be up to 9 lakhs earlier. And 15% tax is applicable on income between 10 lakhs and 12 lakh rupees annually. And finally, for those of you who prefer the old tax regime, well, you got nothing. The budget 2024 has not made any changes to the old tax regime. We can continue to enjoy the various exemptions and deductions as before until the new regime is made mandatory. Now, speaking of the different tax regimes, the new tax regime was introduced to simplify the old income tax system. Now, when questioned about whether the new tax regime would become mandatory, the finance minister stated that the government's intention is to make the income tax regime simpler, and it is uncertain if there will be a phase out of the old income tax regime. A decision will be made only after a review of the same is done. While some tax SOPs have been given to the new tax regimes, there is something else that taxpayers are not happy about, and that is the change in the capital gains tax. One thing that investors were particularly eager to learn about in the upcoming union budget was the potential changes in the capital gains tax structure. Now, this sentiment was echoed in our survey conducted for our union budget expectations video, where majority of the respondents were advocating for a reformation in the capital gains tax structure. Although there were some positive aspects in the announcement, it wasn't all rainbows and sunshine. Now, the capital gains tax system we had was quite complicated, with different tax rates and various holding periods for various types of financial instruments, and some indexation benefits while others did not. However, under the guise of rationalization, the capital gains provisions, there has been a significant increase in capital gains tax liability in most cases. For stocks and equity mutual funds, the short-term capital gains tax rate has been increased to 20% from 15%, while the long-term capital gains tax rate has been increased to 12.5% from 10%. Now, this move seems aimed at encouraging more long-term investing in equities, as the taxation on short-term capital gains has been increased. On the positive side, for the benefit of the lower and the middle income classes, Finance Minister Nirmala Sitharaman proposed to increase the limit of exemption of capital gains on certain listed financial assets from 1 lakh rupees earlier to 1.25 lakh rupees per year from here on. However, the big shock lies in the complete elimination of indexation of cost for all other long-term capital assets, which include unlisted shares, immovable property, gold, overseas shares, and units, etc. Now, the indexation benefit previously allowed asset owners to adjust the purchase price of the asset for inflation, thereby lowering their tax liability. Especially for property owners, this is a significant blow. My colleague Rahil Hassan has made a very informative video on how changes in tax and the removal of indexation will impact property owners. I highly recommend watching it to understand the impact thoroughly. Now, returning to the main issue, we need to understand why the government might have chosen to hike the tax on capital gains, especially at a time when we are seeing significant interest in the financial markets. So why did the government increase the capital gains tax, especially now? With households already paying high taxes through income and indirect taxes, it was inevitable to shift some burden to the more affluent class. Now, this policy aims to balance fiscal needs without overburdening the average taxpayer, ensuring a fairer distribution of the tax load. Additionally, the budget has reduced the corporate tax on foreign firms from 40% to 35%. Now, this is a smart move to attract more foreign investors to set up operations within the country. Plus, they've abolished the angel tax, which is another big step towards making India more and more investor friendly. Now, the angel tax was introduced back in 2012 to prevent money laundering, but it ended up making things difficult for genuine early stage investments. Venture investors are really happy about this change, calling it a huge reform. Now, this move supports the government's Startup India initiative, showing their commitment to fostering innovation and entrepreneurship, which is great for driving economic growth. Now, by removing this major funding obstacle, startups can now access investments even more easily. Now, this will help create more jobs and spur innovation across various sectors. So, what else did the government announce that could affect you? Now, did you know that gold is the second largest part of India's household assets, with real estate being the first? India is the second largest consumer of gold and relies heavily on imports since there's been very little domestic production. Now, in 2024, gold prices have been breaking records almost every month. Several factors are driving this trend, creating a positive outlook for gold prices in both the domestic as well as the international market. Now, these factors include high demand for gold, geopolitical tensions, central banks buying more and more gold, anticipation of a Fed rate cut. So why are we talking about gold at all? Now, in the Union Budget of 2024-2025, the government announced a reduction in customs duties on key precious metals Duties on gold and silver have been cut from 15% to 6%, and the duty on platinum has been adjusted to 6.4%. Now, this reduction is expected to lead to lower prices for all the three metals. It will provide significant relief to customers, especially during the upcoming festive and the marriage seasons when buying gold, silver, platinum and diamond jewelry is very common within our country. Why did the government do this, then you may ask? One reason is to combat smuggling. India imports a lot of gold, accounting for almost over 5% of all imports. Now, this number would be even higher if we include the smuggled gold. The World Gold Council estimates that up to 160 tons of gold are smuggled into India every year, which is approximately 20% of the annual demand of 800 tons. So these changes in customs duty not only aim to make gold, silver and platinum more affordable for customers, but also to tackle the issue of gold smuggling by reducing the cost of legally imported gold. The government hopes to curb illegal activities and ensure that more gold enters the country through the proper channels. Now, as we move into the festive and the wedding seasons, these policy shifts could bring significant benefits to both the economy as well as the consumers, making it a win-win situation for everyone who's involved. Now, keep an eye on these developments as they could impact your buying decisions going forward. Creating adequate, good quality jobs has become the biggest challenge for the government at this point in time. Even though the economy is growing at a rapid clip, its job intensity, which is the ability to create jobs, is low. Now, the government also poured some considerable attention to employment and skilling this time. The government aims to create approximately 4.1 crore jobs over the next 5 years. Now, to support this ambitious goal, rupees 2 lakh crores has been allocated. The budget has some great news for job seekers. Here's what they are doing to create more jobs. Now, for the new entrants, there's a scheme called the Employee Linked Incentive Scheme. Now, if you're new to the workforce, you can get a direct benefit transfer of 1 month's wage, which is up to 15,000 rupees in 3 different installments. For the manufacturing sector, if you're a first-time employee in the manufacturing sector, the government will cover both the employers as well as the employee's share of EPFO, which is the Employee Provident Fund, contributions for about 4 years. Now, this means you'll get more take-home salary. Now, for the other sectors, the jobs within the other sectors, the government will reimburse employers 3,000 rupees per month for 2 years to help with the Employee Provident Fund contributions. Now, to help more women join the workforce, they're planning a working women hostels and crèches. They'll set up places where women can stay and have childcare support. They're also planning women skilling programs. Now, these programs will help women gain new skills and improve their job prospects. They are also launching a scheme to create more internships in the top 500 companies over the next 5 years. Now, interns will get an allowance of rupees 5,000 per month and a one-time assistance of rupees 6,000. Companies will handle training and cover 10% of the internship costs using their CSR funds. Now, this means young people will get valuable work experience and a guaranteed income as well. Now, did the government, by doing all of this, pull the plug on capex? With all the spending, the government has not taken its foot off the capex spending. The last 3 years have seen a significant increase in capex as the government revved up public spending to drive growth in the hope that private investment will follow suit. Now, to put things in numbers, the central government's budgetary spends on infrastructure have grown at a stellar 30% CAGR between FY 2020 and FY 24. Now, it is this public spending that has powered India's strong GDP growth too. And the infrastructure spending focus remains in line with the earlier interim budget announcements in February this year. Overall, capex has been kept at rupees 11.11 lakh crores, which is 3.4% of the overall GDP of the country. Now, this is quite good considering that it will provide continuity and higher visibility for the infrastructure sector. Now, let's talk about how the budget is giving a special push to Bihar and Andhra Pradesh, which is pretty interesting from a political standpoint. So the Janata Dal United and the Telugu Desam Party are really important for the government's stability at this point in time. That's why these two states, which is Bihar and Andhra Pradesh, are getting a lot of attention in this budget. For Andhra Pradesh, especially, the new capital Amravati around 15,000 crore rupees has been allocated. Now this is a big boost for the state as it builds its new capital. Bihar is also getting a lot of focus. The budget has increased funds for developing new airports, medical colleges and highways. Now there's a big push to develop an industrial hub in Gaya as part of the Amritsar-Kolkata industrial corridor. Plus there are major road projects worth rupees 26,000 crores, a rupees 24,000 crore power plant in Bhagalpur and rupees 11,500 crores under the accelerated irrigation benefit program for Bihar. The focus on Bihar is actually a good thing if it helps lift the state out of poverty and backwardness. Now on the other hand, Andhra Pradesh is one of the most prosperous states, ranking 6th in the per capita income, but it still needs a lot of money to develop the new capital, which is Amravati. In short, these budget allocations show a clear focus on boosting development in Bihar and Andhra Pradesh. Though it has a political angle, as long as it's reaping economic benefits, I don't think anyone would bat an eye. Now, how are the government finances looking after the budget? Now, just like how you and I have to take care of our regular expenses and our regular sources of income, the government too must manage its finances. This means ensuring that its income from taxes and other sources is enough to cover its spending on public services, infrastructure and everything else that it needs to fund or pay for. Now it's all about finding the right balance and making smart choices. So the recent budget announcement has made it pretty clear that the government's economic plans haven't changed, even with the recent election results. A lot of people were worried that the election outcomes might push the government to change its focus and relax its fiscal discipline. But that's not the case at all. Let's talk about fiscal consolidation. Basically, this is about the government reducing its budget deficit and debt levels to keep the economy stable in the long run. Now, some folks were concerned that the government might slow down on this front, especially after the elections, maybe to make room for new spending promises or to cater to short-term political gains. But here's the thing, the government has actually sped up its efforts on fiscal consolidation. They're taking stronger steps to control public spending, boost revenue collection, and implement measures that make the economy more and more efficient. Now, the goal is to reduce the fiscal deficit faster than they initially had planned it. For example, the fiscal deficit for FY24 is now estimated at 5.6%, down from the earlier estimates of 5.8%. Similarly, for FY25, the fiscal deficit target is now 4.9%, lower than the previous estimate of 5.1%. Now, this new target is possible because the government got a dividend bonanza from the Reserve Bank of India amounting to rupees 2.1 lakh crores, as much as 0.4% of the GDP, which means higher revenues for the government. Now, the union government did well to partly use the improved revenue position to project a lower fiscal deficit for this financial year. Now, the big goal is to bring the fiscal deficit down to 4.5% of GDP by FY26. Now, as discussed above, capital expenditure, which is spending on things like infrastructure, remains unchanged and is growing at 17% year on year. However, revenue expenditure, which covers things like salaries and subsidies, has been increased from 4.6% in the interim budget to 6.2%. And nominal GDP growth for the economy has been pegged at 10.5%. In short, the latest budget continues to focus on reducing the fiscal deficit. This has been done without giving any major tax concessions, barring the hike in standard deduction for the salaried employees. The budget has carefully balanced the goal of fiscal consolidation with the need for essential spending. Despite reducing the fiscal deficit in the budget proposal, revenue expenditure has increased. Now, this indicates that the quality of spending has not been compromised. The finance minister has managed to address the immediate needs of the economy while also investing in the future. Now, this includes significant funding for agricultural research to boost productivity and ensure food security. Additionally, there is a focus on human capital development, which involves investing in education, skill development and healthcare to enhance the capabilities of the workforce. Now, the budget also allocates funds for space exploration, aiming to position the country as a leader in space technology and innovation. By balancing current economic demands with long-term investments, the budget seeks to support sustainable growth. The finance minister has ensured that while immediate economic needs are met, there is also a strong emphasis on building a foundation for future prosperity. With that, this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.